Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, strategists, analysts, money managers, authors, educators, trying to understand how they approach the markets, what tools, techniques, routines they use to understand the world around them as investors, their current outlook and what shapes that outlook, what informs their decision making, what evidence they're following, and what they are reading and listening to. Today, a great interview, one I hope you'll enjoy, with Mike Singleton. Mike's a senior analyst and principal at Invictus Research, based in the Boston area. I've known Mike for a number of years, have been able to interview him over time. When I think about Mike, I think about someone who does a fantastic job of translating what is often seen as a very confusing and challenging and information-filled and discipline of macroeconomic analysis. And I think now more than ever, investing has felt like a macro call, right? Things like inflation and wage growth and the Fed and tariff policies and their implications just leave more questions than answers. So I was able to ask Mike about a lot of things along those lines. You know, he sort of laid out right at the beginning, what you'll hear is how he approaches the markets. Basically, three things to consider: real growth, inflation, and monetary policy. We went through each of those, and as you'll find, I very quickly discovered how intertwined they really are, and really understanding the relationship between those three different factors is the game. Really appreciated my comments about why we haven't seen as much of an impact on company earnings and on inflation due to tariff policy and potential implications there. Talk about the weaker dollar, U.S. versus non-U.S. markets, the interest rate environment, the Fed, and being a little too hawkish, maybe turning a little more dovish. What would cause Fed governors to change their tune and sort of feel like they need to be more aggressive. And you'll see some examples of where I think Mike does a really good job of thinking about relationship, what tends to lead what, where you can look for signal that'll help you understand this other thing over here, all through the lens of macroeconomic policy, but really applying the best practices of technical analysis. Maybe that's why I value Mike's perspective so much. I feel like he applies my toolkit to macroeconomic data in a fantastic way. So please enjoy this interview with Mike Singleton of Invictus Research. Super excited to be catching up today with Mike Singleton. Mike's the senior analyst at Invictus Research, coming to us from the Boston area. Mike, good to see you again. It's been a little while, but I'm excited to get your take on the markets. But welcome to the show.
It's always a pleasure to be here. Thanks for having me.
So I think of you, Mike, as one of those people who has I would argue, a very rare talent of taking what many consider a complex and overwhelming discipline, which is macroeconomic, analysis, and just there's so much information, there's so much data, there's so much news flow, and I think a lot of people struggle to kind of connect all this stuff to an actual investment thesis, and I think you do better than anyone at making that connection. Can you describe a little bit your macro process, right? How would you describe, I guess, your general investment approach? What kind of defines your routines as you're trying to digest all of this information out there?
So I think you're right that macroeconomics does have a reputation for being somewhat esoteric or complicated. And the good news, thinks that is, you can really distill it into just three variables. The only three things that matter in terms of macro are real growth, inflation, and monetary policy, or interest rates. And everything else that we talk about, sentiment surveys, diffusion indexes, whatever, only matters to the extent that it impacts those three variables: real growth, inflation, and monetary policy. I'll also say that it really, really helps to fuse whatever macroeconomic analysis you're doing with technical analysis, because there is no discipline within investing that is prone to going far afield and getting lost in the sauce, so to speak, than macro, right? You can have some really harebrained macro theses if you're not also watching the markets as a way of sort of sanity checking what you're thinking. So what I find is actually that a lot of times technicians and technical analysts have a more accurate perception of economic conditions than macroeconomists with PhDs. So anyway, it's a long way of saying at Invictus, what we try and do is understand what's going on in terms of the macroeconomics and the fundamentals, but we marry it with market analysis, including some technical analysis.
I love that. I promise I did not see that comment in your head, but I'm sure if I Venmo you, it's at Mike Singleton, right? For the tip for that one.
Perfect.
No, really good point, Mike. And I think that's true. I would totally agree, right? I think it's very easy to get lost in all of the macro stuff, and combining it with some technical approaches, which really are designed to kind of cut through the noise and focus on trend and inflection, makes a lot of sense. And I know just from following your work and some of the reports that you've shared, you do a really good job of sort of looking with a technical lens at different, at different relationships, and looking, lining up some analogs, and seeing what might logically come next, I guess, based on historical patterns. So this is a really cool framework, thinking of these three items, real growth, inflation, monetary policy. If we could, can we go through each one of those and just talk about where we're at right now? Because I think that's the big question mark. If we could start with inflation, just because we're in the middle of a bunch of inflation data coming out this week. We had the CPI yesterday, the PPI, and that's sort of top of mind for a lot of investors, given tariffs and tariff announcements and potential impact. When you're looking at the inflation data more recently, what does it tell you about expectations going forward? And I guess the follow-up question, are you surprised or not that we haven't had as much of an impact, given a lot of tariff decisions that on the surface appeared that they would be inflationary in some way? So help us make sense of the recent data here.
So let's just describe the recent data first. Through February, you were seeing accelerating inflation. In other words, the month-over-month rate of change in headline CPI, core CPI, headline PCE, core PCE was going up. Since February, it's been going down more or less. So we went from a regime where inflation was running at something like 3 to 3.5% to now it's running very close to 2%. The CPI print today was a little bit hot, but it doesn't change the fact that we appear to be in a disinflationary regime. Are we surprised to see this given the tariffs? At Invictus, we would say no, because tariffs are ultimately a tax. And so we know if there's no policy offset for the tariffs, they're taking money out of the economy, right? Out of the private sector and kind of putting it back in the hands of the government, if you want to frame it that way, right?
Yeah.
And all else equal, if you're taking money out of the economy, it's generally not inflationary. Now, what you will see is the price of select goods go up, right? Perhaps the goods that are being tariffed. But because there's no more money in circulation, if you're holding all other variables constant, the broad price levels, right, the headline inflation number shouldn't really be that affected by tariffs, or perhaps it's a slight disinflationary, slower growth sort of influence. In terms of our outlook for inflation going forward, we're inclined to think that for the time being, inflation continues to slow on the margins. On the one hand, we think goods inflation will probably remain stable. Commodity inflation, set the stage here. The most important inflationary commodity by a wide margin is oil. It's an input cost into virtually everything. And our trend work on oil is very simple, right? It's still below its 200-day moving average. Most of its important moving averages still have negative slopes. Our bias there is going to be that the trend in oil persists. We know it's a trend following financial exposure. And, as long as the 200-day moving average for oil is sloped downward, we're inclined to think commodities are going to be a headwind for inflation. Finally, the labor market is also a really important driver of inflation. And the labor market data is broadly softening, whether you're looking at hours worked, if you're looking at the trend in jobs added each month, if you're looking at the quit rate, job openings, no matter which way you slice it, the labor market is softening. And the reason that matters is because it means that wage growth is softening. And wage growth actually tend to have about a 90% correlation with services inflation x energy going back over the last 20 years. So if we're seeing softening labor market data, softer wage growth, that means we should see softer services inflation. And you add all of these factors together, and the outlook is for headline or core inflation of, call it 2 to 2.4% at an annualized pace over the next, call it 3 months.
Very, very interesting, Mike. And I can't help but notice, of course, in a recent presentation, you sort of hit on this point. The Fed has sort of made it very clear 2% annual inflation is kind of their bogey, right? That's sort of what they're ideally looking for. So we're continuing to have inflation remain relatively low, but still not quite to that sort of Goldilocks level that was talked about. How much of an issue do you see that? Is that sort of just a rounding error, not that big of a deal, or do you think that it informs some sort of Fed decision down the road we're not ready for yet?
So I think ultimately, in terms of Federal Reserve policy, they're trying to balance the two parts of their mandate, that the inflation part and the labor market part. And, you know, the House view at Invictus right now is that interest rate policy is too tight. So in the first quarter of 2025, nominal GDP grew at 3.2% at an annualized pace. That was a multi-year low, a cycle low in nominal growth. And the Fed funds rate right now is 4.3%. So what that means is that the effective Fed funds rate is 100 plus basis points above the rate of nominal growth in the US economy. That's really, really restrictive. Essentially, monetary policy is very, very tight relative to economic conditions. So the question is, does that make sense with inflation, call it 40 basis points above target on a 3-month annualized basis, and all of the labor market data pretty clearly slowing? Should you be that restrictive relative to economic conditions? And I would say no. I mean, I think that the Fed probably could cut 50 or 75 basis points from here without the risk of inflation running away from them. So ultimately, why does that matter? The Fed right now is signaling very hawkish policy. If you look at their summary of economic projections and what they're indicating to the market about interest rate policy through 2025, we think that they're going to have to adjust their view in a more dovish direction. We think they're going to have to cut more quickly and by more than they're signaling as a result of cooler than expected inflation data and softer than expected labor market data.
Interesting. And it's fun as we go on, Mike, I had this great idea as you initially talked of these three separate things: real growth, inflation, and monetary policy. I immediately realized how intertwined these all are, as I'm sure you know very, very well, right? I mean, that's the game, is sort of balancing these three. So with that, I mean, a really good points well made about the Fed with a fairly hawkish approach, needing to maybe turn a little more dovish. They've been hesitant to do so, at least the comments that I've said, and one of the more recent comments is just a lack of, or maybe a lack of confidence that inflation is sort of reflecting everything and sort of waiting to see. What do you think, not that you, I think, have a crystal ball or can get inside the head of Fed governors any better than I can, but what do you think are the things that Fed governors, Powell and others, would see that would compel them to be more aggressive in rate cuts? Right now, I mean, the market's pricing in, 1 or 2 rate cuts, maybe starting at the September meeting initially. What do you think would actually compel? What would be that thing that they would say, okay, now we need to take action more aggressively than we originally planned?
I think probably the most obvious, the most compelling answer would probably be jobless claims ticking above 250,000 on a weekly basis. I think that's probably the most likely over the next 2 to 3 months. And to be clear, I don't think that would signal a recession, but I think that would make labor market risk imminent enough that it would compel action from policymakers. So that's a time series that we're watching closely every week, even though there's really no sign of significant layoffs yet.
Right. Okay. Let me, if I could, bring up a chart here. And the chart I want to look at, and again, this sort of speaks to my comment I was just trying to make about how my absolute poor job at laying out the structure of this interview becomes clear to me, because you're reminding me how related these all are. But can you talk through this visual in particular? This is relating some of the things we talk about, right? Looking at real growth, looking at inflation, and looking at monetary policy. I feel like this order of operations, investors often flip it around, right? And they look at policy as like the leading indicator of things. Can you just talk about the relationship and how you relate these different parts of the business cycle?
So I would say there's 3 things I would note about this chart. I mean, the first is what I said at the beginning of the presentation: growth, inflation, monetary policy. That's really all that matters. If you're ever confused or feel yourself getting lost in the data, if you just relate it back to those 3 things, that can be like your North Star.
Yeah.
This chart demonstrates is that it's the rate of change in growth and inflation that matter, right? The level does matter, but the rate of change is primary. So, in a sense, it's less important that real growth right now is about 1.75%. It matters more that we're coming off the kettle, so to speak, of 2.5%. And then in terms of what leads what, which you just mentioned, boy, it's really hard to say. I think a conventional understanding, right, is that policy leads growth, which leads inflation. But we also know that inflation is an input into policy. and as is growth. So you really have to consider them all together, and as a part of the broader business cycle, to really make sense of it. And simple, charts like this are a simplification, but hopefully they still make some good illustrative points as well.
Yeah. And I love your point. This goes back to your point of sort of looking at things with more of a technician's, I guess, mindset of looking at the rate of change, looking at inflection points, and thinking about what that might represent. I think that's really well said. Not to completely cherry pick on some fantastic charts that you shared with me here, Mike, but I just want to talk a little bit about the performance, because a lot of people, I think, are looking, or at least individual investors that I've heard from, looking at economic data, concerned at the lack of growth, or I guess underwhelming growth data, and thinking that reflects pretty poorly on stocks here, and are skeptical as to why the market risk assets have gained so much in the face of basically signs of a weakening economy. Can you talk about the relationship between real growth and equity performance, what that means here?
Right. So what this chart is showing is the relationship between the ISM manufacturing PMI, which sounds really like a mouthful. All it represents is the growth cycle. It's just a measure of growth over time. So up means faster growth, down means slower growth. And you can see that the S&P 500, one, correlates very closely with it, and two, leads by about 3 months on average. So there's two takeaways from this chart. The first is that over the long term, the fundamentals drive the performance of the financial markets, right? Technicians know this. They talk about the primary trend, the longer term trend being driven by the fundamentals. And this is just a graphical representation of that. The second is another important technical point. The market is a discounting mechanism. So you could use any measure of growth. And what you would always see is that the stock market broadly, or whatever financial market, the internals of the stock market, they always lead the economic data by, call it 3 to 12 months, depending on whatever indicator you're looking at. Manufacturing tends to be a leading indicator for economists. So the stock market only leads by 3 months. If we were looking at a quote unquote lagging indicator like the payroll data, you'd see that the stock market actually leads by closer to 12 months. You'd also see the correlation break down a little bit. But nevertheless, the fundamental story of this chart would be the same. Growth drives stocks over the long term. That's the point.
No, really, really well said. To take one more slide that you shared and just talk a little bit more. The word recession has not come out of our conversation just yet. I'm curious because a lot of people are sort of speculating on: are we in a recession? Were we in a recession? Will we be in a recession? And all the implications of what that means. Talk to us about sort of the economic regime you see us in, and how does that inform your outlook going forward?
Right. So right now, our outlook at Invictus is for deflation, slower economic growth, and slower inflation. So you probably look at a chart like this and you see that historical stock market performance is poor. But this sort of brings us to a limitation of back tests, right? And that's that they're, one, always backward looking, and two, they're simplifications. They're just mental models. So we have to be kind of careful here before we go out and just start shorting the stock market. All recessions are deflationary events. So this back test captures all deflations, including a lot of recessions, which are always bad for stocks. But it's important to acknowledge that not all deflations are recessionary. So our outlook right now is for a non-recessionary growth slowdown. So we really have to consider, how do stocks tend to perform historically through non-recessionary growth slowdowns? And that's kind of our base case that we start to, how we set our expectations, and we calibrate off of that base case. And the answer is, when you see a non-recessionary growth slowdown, usually, historically, the stock market earns 2 to 5% annualized returns, but with a lot of volatility. So it doesn't mean 30% drawdown. It doesn't mean buy VIX futures or whatever. It really just means that returns are low relative to average and more volatile. And I think that there's some reasons that you could make the case for better returns. A lot of it has to do with expectations about monetary and fiscal policy looking forward. But the point I'm making is, even though we're deflationists right now, we're not bears on risk assets as a result.
No, really, really helpful. I appreciate that, Mike. Another area that you wrote about recently, or credit spreads, right? We've seen high yield spreads relatively narrow, non-U.S. credit spreads. I mean, a lot of them narrowing. What does that tell you about, I guess, the bond market's assessment of risk? And again, how does that relate to some of the other themes we've discussed here?
So I'll answer that question in two parts. The first is the relationship between credit spreads and the economy, because you can deduce market signal from price action and the financial markets, like I said. So when spreads are narrowing, maybe it's obvious. It means credit risk is declining, the credit worthiness of borrowers is improving. Now, how do we relate that to growth and inflation? What's usually happening? Well, it's a very reliable indication that growth is actually going to accelerate. So the fact that credit spreads are declining right now, that they're, say, below their 200-day moving average, is an encouraging sign about the economy. In other words, even though clearly, if you look at the data, growth is slowing right now, the credit market is saying, things will resolve in a positive way and ultimately growth will accelerate because they lead the measured economic data. The second point I would make about credit spreads, especially as someone who's sort of stock market oriented, is when credit spreads are declining, generally returns for stocks are much better. So to the extent that you are an intermarket analyst and you see credit spreads demonstrating a strong downward trend, it's an indication that the market is risk on, and it's an indication to sort of take net exposure, take risk up on the margins certainly relative to what you would be doing if spreads were widening. Generally, if spreads are widening, that's a classic risk off sign that you should be taking down net exposure.
Yeah, no, two very, very good points there, Mike. We interviewed George Noble on the show not too long ago, and one of the things we agreed on was when conditions are good, the people that we found at a large firm that were most attuned to potential risks were the fixed income desk, the bond desk, and we had the high yield desk sitting not too far from us at Fidelity. I would love shooting down there and just get a take on spreads and conditions, because when those start firing, it's often before you'd see real risks manifest in equities, but it told you to start thinking more defensively. So I 100% agree with what you said. How does that, in terms of credit spreads or just the general macro conditions, talk to me a little bit about the weaker U.S. dollar, and I'd love for you to tell me, if you could, and I'm guessing, knowing you'll probably give me a nuanced answer that I'll really appreciate. Is the weaker dollar we've observed in 2025 a good thing or a bad thing? Right? Should we be optimistic because of the weaker dollar? Should we be concerned that the dollar speaks to, lack of economic optimism? Talk to us about the trend in the dollar and what that tells you about conditions here.
So what I would say is, I think, so historically, the performance of the dollar and the coincident performance of stocks is very low, right? Whatever the dollar is doing, it usually doesn't affect the stock market. That said, US stocks are denominated in dollars, so there is a relationship. The question is, what's the relationship? And I mean, I would say that what we've seen in 2025, particularly through April, what we saw was global investors, in particular, European investors who invest in euros, allocating away from US assets and into other stuff, a lot of which has been European stuff, right? Because, European stocks have really outperformed, and European assets broadly have done pretty well, and they're making all sorts of investments in military and so on and so forth. That's not necessarily a bad thing for the US. It just sort of represents sector rotation on a global scale. I actually think the really interesting question is, when the dollar declines dramatically, let's say when it sees a 2 standard deviation move lower over the course of 3 months, what do historical returns look like for stocks going forward? Because theoretically, a weaker dollar should mean easier financial conditions, right? Every financial condition index includes the dollar. And the answer is pretty well, right? A sharp decline in the dollar usually presages above average stock market returns. And there's different ways we can measure that, one of which is something called a T-stat. Usually when the T-stat is above 2, it's statistically significant. The T-stat looking 3 months out, or maybe 6 months, between 3 and 6 months out, for these momentum thrusts lower in the dollar is 1.6. So it's not a really strong indicator, but 1.6 is still enough that we're paying attention to it. So we actually view the price action that we've seen in the dollar as bullish on a look forward basis for US stocks and also for global stocks.
It's you mentioned non-US equities doing so well, and non-US markets showing quite a bit of strength here in 2025, undeniably so. Based on what we've seen with the trend in the dollar, I think a lot of investors kind of pre-2025 were ignoring non-US markets, justifiably so, because they were just underperforming the US for so long. Now the tables have completely shifted. How do you think about allocation non-US versus US, given all the macro conditions we've talked about, focused more on the US markets?
So, I would say at Invictus, generally, we are more focused on US markets.
Yep.
And I would say long term, I'm not especially bullish on Europe or really any developed market except for the US because candidly, their demographics are really, really poor and their economic systems are highly regulated. So if you have very low or negative population growth and very restrictive economic systems, that sort of handicap productivity, it's really hard to be long-term bullish. And look, can a big fiscal package cause European stocks to outperform over the course of a year or maybe two? Of course, but you can't print your way into prosperity as most folks in markets understand. So it's hard to be strategically bullish on at least developed market equities outside the U.S. I will say there are non-dollar assets that we like. I mean, we continue to like gold. We wouldn't be underweight gold here, and also Bitcoin. So something that I've been noting to clients with varying degrees of success is that Bitcoin over the last 6 months has the highest Sharpe ratio of any cyclical asset class that we track. So large cap stocks, US stocks, commodities, real estate. Bitcoin has the highest Sharpe ratio, which means risk adjusted return, right? For the last 10 years, the argument against Bitcoin and institutional adoption has been that it's too volatile and it's too risky. But we just saw Bitcoin outperform stocks, through a 20% drawdown in stocks, right? And to us, one, I think that type of relative strength, excuse me, generally presages strong returns, which we've since seen. And two, I think that there are a lot of quantitative models that are going to start incorporating more Bitcoin as its return statistics and correlation profile improve, right? All of these portfolio optimization models, from simple ones used by financial advisors to more sophisticated vol targeting models used by institutional investors, are going to essentially be forced to start allocating more, larger and larger weights to Bitcoin as a result of this strong performance. Of course, all of that can change quickly if there's some sort of big crash or something. But as things are right now, we think the setup for Bitcoin is quite attractive.
It's so interesting because I feel, it's still a relatively young asset class compared to many others that we've tracked, obviously, right? And you can track historically for decades, if not centuries. I feel like as they're battle tested more and more, right? There are a lot of question marks. What would happen to cryptocurrencies during a big equity drawdown? 2025 has shown it actually can be a pretty successful run for cryptocurrencies. Mike, you work primarily with institutional investors. Where do you see things at in terms of the maturity of, or I guess the widespread understanding and appreciation for cryptocurrencies as an asset class? I feel like we started with no institution would ever touch it no matter what, because it's the wild west of volatility, to it is an obvious, how could you have a model that doesn't include cryptocurrency? Where are we at in that kind of spectrum based on your conversations?
I'd say very, very low in terms of adoption. So
yeah.
I occasionally, through a gold bull market, I'll do podcasts with various gold channels. And one of the statistics that they frequently reference is that among financial advisor assets, something like only 3% of assets are allocated to gold, right?
Right.
For an asset that has really wonderful diversification properties over the long term,
Yeah.
everyone is really underweight gold. That's true. I believe that. I think that's just a statistic, right? The market cap of Bitcoin is 1/10 of gold, right? So what does that suggest about how, big investors, how global capital generally is allocated? It's very underweight Bitcoin for an asset that's returned, that has a return profile that's very, very compelling, and increasingly a correlation profile that's also very compelling, and a volatility profile that's increasingly compelling. It's just hard for me to imagine that institutional demand for exposure to this return stream doesn't improve over time.
Yeah. Yeah. No, really well said there, Mike. So listen, one final question, and this has been awesome, by the way, and I appreciate so much, as always. You've kind of taken what so many consider a very confusing area of financial analysis and drawn on some key takeaways across the board. Of all the different charts and relationships that we've talked about, what would be the most important, if you could stamp it on every investor's brain as this is the one thing to follow what would it be and why?
That's a good question. And I think there's a macro part of me that would say, something like the growth data, real growth is what drives stocks over time. I would say, and that's true. I think that it behooves everyone to understand what's going on with the economy, whether you're just a citizen or whether you're an investor. I would say from an investment perspective, if you are interested in sort of outperforming the market over time, it would really be relative strength.
Yeah.
So I'd say if you could only have one technical indicator besides price, I would say relative strength is what I spend, by far. That's the number one screen that I use when I'm looking for, individual securities.
Mike, it's not within my power to authorize honorary CMTs, but if I could, I would give you one for that comment. I think that's well said, focusing on relative strength, especially when you're looking at intermarket analysis. I think that tells you so much about what's working and what's not, and when there are changes in those relationships. Mike, great to see you again. Thanks so much for some really thoughtful perspective here as we go through uncertain times for a lot of investors. I hope this puts their mind at ease a little bit in terms of some key things to look at, and I appreciate your perspective as always. Look forward to talking to you again soon, but in the meantime, thanks for sharing time with us today.
My pleasure. Thanks again for having me.
Great conversation with Mike Singleton of Invictus Research. I hope you appreciated that one. Really enjoyed his way of sort of laying out all these different moving parts, some of the key things to focus on. I asked him at the end, most important chart, and I really appreciate as always, his ability of focusing in on the actionable movements, the actionable data. Boy, really appreciate his thoughts on looking at relative strength as a key factor. 100% agree. Could not agree with him more on that. When I think about the technical toolkit, it's all about analyzing price and volume and sentiment, looking at trends, looking for inflection points. But of all the tools that I have available to me, relative strength, which is simply looking at how one thing compares to something else and different iterations on of those relationships. 100% agree. That's the game. That's the most important decision, most important set of information you should consider as an institutional investor. And I think more individual investors and advisors could really help themselves by focusing on relative strength, which is a lot of what we do in our own work for sure. Really appreciated his comments about tariffs, about inflation, about the Fed, about some of the data we've seen recently, outlook for the Fed going forward, and just thinking about the relationship between all these different moving parts. I look forward to keeping in touch with Mike as the year progresses, as we get to a point where the Fed actually starts taking action and maybe starting to lower rates. It'd be great to circle Mike back in and see if that has evolved, or see if his perspective has evolved as evidence changes around us. By the way, if you want to learn more about relative strength investing, some of the tools and techniques we can apply to economic data and other stocks and ETFs, using the best practices of technical analysis and behavioral finance. If you want to upgrade your own awareness of those disciplines, our Market Misbehavior Premium memberships may be a great gift to yourself to upgrade your decision making through the remainder of 2025 and beyond. 3 great benefits to the premium membership. First off, you'll have access to all of our virtual courses like Flight School Behavioral Investing, where we teach you all about behavioral biases and technical analysis tools. Second, you will have access to all of our members-only reports, like our weekly flight plan. That is our main report where we look back at the week that just happened. We look forward at the week to come. What levels, signals, patterns are we most attuned to? Also, our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have full and immediate access to our members-only community. You'll be part of a small inner circle of like-minded investors looking at charts, looking at the markets, asking questions, learning from each other. I'm in there every morning answering questions from our premium members, and it's been such a joy nurturing a small group of investors to greater investing success. For more information, all those great benefits of the premium membership, go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. For Market Misbehavior, I'm Dave Keller. Thanks so much for watching and listening. And remember, it's always a good time to own good charts.